Behavioral Finance and Wealth Management. How to Build Optimal Portfolios for Private Clients by Michael Pompian. Hi everyone. Today I am going to review the book, Behavioral Finance and Wealth Management. How to Build Optimal Portfolios for Private Clients by Michael Pompian. Behavioral Finance Explained. Behavioral finance focuses on the psychology of financial decisions. It takes issue with some fundamental assumptions of conventional finance, especially the notion that markets are efficient and investors are rational. In an efficient market, securities prices supposedly reflect all relevant information so rapidly that no investor can hope to beat the market average over the long term. We want to identify relevant psychological biases and investigate their influence on asset allocation decisions so that we can manage the effects of those biases on the investment process. This conventional financial thinking leaves no room for irrational market behavior. It assumes that prices reflect everything known or knowable about value. Yet, persistent anomalies show that investors do indeed act somewhat irrationally. For example, investors consistently overprice growth companies and underprice unfashionable companies. In fact, the value style of investing depends on this anomaly. For other investors, timing is everything. If you think you may have made a bad investment decision, confront the problem head-on and rectify the situation. Economists such as Adam Smith were aware of the role of emotion and other irrational factors in decision-making. However, neoclassical economics moved away from these ideas and developed the notion of a homo economicus, a theoretical model of a perfectly rational decision-maker. This approach to analyzing the economy dominated from the late 19th century to the mid-20th century, when experiments in psychology and economics revealed its failure to account fully for human behavior in financial matters. Investor irrationality has existed as long as the markets themselves. Understanding people's emotional biases and their impact, and knowing how to guard against them, is fundamental to making better investment decisions. Investment advisors should consider each client's particular biases when devising portfolios. Wealthier clients may be better able to afford their biases than less well-to-do customers, but advisors will find that most clients' cognitive biases are easier to moderate than their emotional biases. At the extreme, emotional biases may require advisors to adapt their financial plans to their clients' beliefs, even if those beliefs are not completely rational. Common behavioral biases. Investment advisors and investors can put behavioral finance to practical use in overcoming common biases which range from overconfidence, cognitive dissonance and probability estimation errors to optimism and regret aversion. This is how some of them work. 1. Overconfidence. Investors with this bias have excess faith in their ability to forecast events. 1. The investment consequences include costly overtrading, blindness to risk, failure to diversify, and a tendency to ignore contradictory information. 2. Representativeness. Genuinely revealing events illustrate true trends, not anomalies, but recognizing such events is challenging. 2. Instead, people cling to long-held perceptions. 3. Anchoring and adjustment. Fixed ideas often are more dangerous than adjusted perceptions. 4. Some investors arbitrarily fix on certain numbers, so their buy or sell decisions may be irrational because they have a particular number in mind, unadjusted over time, such as an initial expectation about a stock despite new discouraging data. 5. One of greedy investors' most dangerous tendencies is failure to adjust to reality and neglect of likely probability. 6. They tend to ignore real probabilities when they hear a hot story about a new opportunity. 7. For example, investors routinely bid up stocks sold in initial public offerings, though only a few make long-term investment sense. 8. Cognitive dissonance. Investors who find colliding perceptions exceptionally unsettling may seek to avoid discomfort by ignoring uncomfortable information and rationalizing irrational decisions. 9. Thus, They may ignore losses and throw good money after bad. 9. Investors overly affected by cognitive dissonance tend to make contradictory misjudgments, so they may believe in cutting losses, as a general rule, yet justify holding on to a losing stock. 10. To prevent cognitive dissonance from leading to serious losses, investors must face the facts, assess their decisions and take appropriate rational action. 11. Availability. Abundant information wrongly dictates probability to some investors. 12. For example, people think sharks' attacks are likelier than pieces of airplanes falling from the sky. 12. In fact, the contrary is true. 13. The availability of public information about shark attacks is greater, however, because the media gives them more attention. 14. To guard against the investment consequences of the availability bias, investors must carefully examine the factual basis for their decisions. 15. Self-attribution. Investors who habitually take credit for their market successes have this bias. 16. They also tend to blame external factors or other people for market failures. 17. This bias breeds overconfidence, overtrading, inattention to contradictory information and poorly diversified investments. 18. Illusion of control. Investors with this bias believe that they exert power over uncontrollable forces. 19. The same illusion affects craps shooters who irrationally throw the dice harder to roll high numbers. 20. Investors need to acknowledge that investment is a probability game, and that their decisions to buy or sell do not affect an investment's performance. 21. Investors who want to overcome this illusion can try monitoring and analyzing their investment motives. 22. A diary of an investor's reasons for making securities trades can serve as a helpful prophylactic against this bias. 23. Conservatism. This bias inclines people to hold on to prior opinions and forecasts despite changing conditions. 24. It may reinforce unwarranted optimism or pessimism. 25. Optimism. An upbeat attitude may be an admirable personal trait, but it also can be a costly habit. 26. Investors with too much optimism may overweight their portfolios with their employer's stocks, overestimate the relative value of their investments, give too much attention to rosy business scenarios and put too much confidence in their investing savvy. 27. Ambiguity aversion. Investors who need certainty and prefer clear risks to unclear ones share this bias. 28. It may lead people to want to own only what is familiar. 28. The consequences can include building too little risk into an investment portfolio. 29. Endowment. This bias inflates prices. 29. Investors who value what they have too highly and undervalue what they lack have this bias. 30. They ask a higher price for something they own than they would pay for the same asset if they did not own it. 31. Ownership itself somehow adds an irrational dimension of value. 32. Among other consequences, investors with money-losing stocks may be unwilling to sell and cut their losses. They may exaggerate the importance of transaction costs to rationalize their refusal to sell. 33. Mental accounting. Investors who disregard correlations and total returns may suffer from this bias, which shapes attitudes toward money, depending on whether the money is earned, inherited, or received through chance or luck. 34. Investors with this bias may take more risks as they get richer, or they may hang on to investments that did well in the past, even if recent performance rationally suggests letting go. 35. Confirmation. Investors with this tendency pay attention mainly to information that confirms their beliefs and often disregard contrary information. 36. Hindsight. Investors may believe that past events and trends were predictable, even if, in fact, they were not. 37. Hindsight is not 20/20. 37. For instance, many people believe that they knew the stock market bubble of the late 1990s would pop. even though their investment decisions say otherwise. 38. This bias may cause people to praise or blame their investment advisors for past advice. 39. Loss aversion. Investors bent on making money with each investment suffer this bias. 40. The result is that instead of selling a soured investment and taking a loss, they write it down. 41. These investors too often sell winning investments prematurely. 41. Loss aversion also can lead to excessive risk in the form of imbalanced portfolios. 42. Recency. Investors with this bias are likely to overweight recent memorable events, a tendency that has contributed to the psychology of investment bubbles. 43. Investors who lack historical perspective mistakenly tend to project current trends into the future, and to pay too much attention to price and too little to value. 44. Regret aversion. This bias deters decisive behavior. 44. Investors afflicted by regret aversion avoid decision-making to sidestep the consequences of suboptimal decisions. 45. This bias leads to poor judgment among investors who fear not only losing money but also sustaining a blow to their pride. 46. Regret-averse investors may be overly conservative. 47. They resist investing in distressed markets, even though buying low and selling high is smart. 48. This bias can cause investors to seek safety in numbers and to run with the herd, although herd behavior poses all sorts of risks. 49. Victims of herd behavior routinely overpay for stocks or hold on to winners too long, instead of selling and taking profits. 50. Framing. Investors use this bias to reshape their perceptions. 50. Yogi Berra exhibited framing bias when he said, "You better cut the pizza in 4 pieces, because I'm not hungry enough to eat 6. 51. Framing bias can cause people to focus on risk to the exclusion of gain, or gain to the exclusion of risk, depending on how the investment advisor phrases a question. 52. Status quo. Some investors suffer inertia because their present state routinely seems safer than any change. 53. This bias may lead people to hold on to assets that are not suitable for their situation or station in life, as in the case of a young heir who inherits a portfolio from a grandparent. 54. Even when minor portfolio adjustments would make sense, these inert investors may resist taking any action. Many investors lack self-control in other ways, as well. A lack of self-confidence and self-control often cause failure to save, to plan ahead and to exercise investment discipline. The cure may be a disciplined reduction in spending, coupled with implementation of a long-term savings and investment strategy with appropriate asset allocations. For example, a rational way to deal with anticipated tax liabilities would be to open a savings account, set aside money each month and earn interest on that sum until it's time to pay the IRS. Yet most people seem to distrust their ability to set aside the necessary savings. Instead, they let the government withhold the money and earn no interest on it. One of the best ways to prevent your biases from affecting your decisions is to keep the rational side of your brain engaged as often as possible. If all investors acted rationally, their actions would be independent of personality type and gender. But research demonstrates that the investor biases correlate with both factors. Women and introverts tend to be more risk-averse than men and extroverts. Attentive investment advisors should be aware of these influences and should craft investment plans that suit each investor's personality. Some advisors even give clients personality tests to determine their investment psychology and tolerance for risk, and then use the results to shape portfolio strategies. Neuroeconomics. The study of neuroeconomics is the frontier of behavioral finance. It centers on how the brain's chemistry and anatomy can influence investment decisions. The major influencers include: 1. Dopamine. When people expect pleasure, the body releases dopamine, which makes people more inclined to do what brings pleasure. 1. Anticipation produces more dopamine than achievement. 1. Dopamine may be at work when people rush to get in on a hot stock. 2. Serotonin. Low levels of serotonin occur in connection with depression, anxiety and impulsive behavior. 2. Low serotonin levels can make people reluctant to cut their losses. 3. Amygdala. Fear drives this portion of the brain. 3. Problems occur in the amygdala in connection with schizophrenia, depression, phobias and other disorders. 3. Fear creates investment opportunities in market downturns precisely because herds of investors irrationally stampede to sell. 4. Prefrontal cortex. Associated with memories and planning, the prefrontal cortex may suffer from aging, a factor that investment advisors should consider when working with the elderly or infirm. 5. Nucleus accumbens and anterior cingulate. These portions of the brain are associated with pattern recognition and choices. 5. They may lead people to detect patterns that don't actually exist. 5. Because the brain is wired to look for patterns, insightful investors are habitually skeptical of the significance of perceived patterns. Takeaways. 1. Recent research challenges the efficient market theory, which says that well-informed investors determine market prices by making rational choices. 2. Even proponents of this theory acknowledge that investors often behave irrationally. 3. In the past 2 decades, research into the psychological and emotional aspects of investing has turned into a new science, behavioral finance. 4. Investors are subject to well-defined and even predictable biases that lead them to make irrational decisions that are bad for their fiscal health. 5. Investment advisors can use behavioral finance to serve their clients better. 6. To prevent biases from resulting in bad decisions, investors should gather complete information and bring rationality to bear. 7. Investors blinded by old views refuse to process new information. 8. Some investors have difficulty controlling their desire to spend instead of save. 9. Gender and personality type demonstrably affect investment decision-making. 10. Neuroeconomics, the study of brain anatomy and chemistry, could open new frontiers in the understanding of investment decisions. Please like, share and subscribe for more videos. Thanks for watching.